Trump is doing with the tariffs. We're seeing foreign selling. And if you think about it, if a foreigner loses money, if a foreigner owns a U.S. stock and that stock goes down 10%, well, that's painful. They lose 10%. But if the dollar goes down 10%, well, then they go to convert their dollars back to their home currency. And so now they've lost 20%. So yes, we're seeing foreign money coming out of the U.S. stock market. And I think that trend has quite a ways to run. But more importantly, just to answer your question about, let's define the sovereign debt bubble. So, this is what I call a death cycle or a death doom loop. And it's pretty straightforward. The federal government has $37 trillion in debt, and my book lays this out and shows you how rapidly that's grown. And then, as Powell pushed interest rates up to try and deal with the COVID inflation, interest expense has grown as well. So now the U.S. federal government spends close to $1.2 trillion a year on interest, just on the existing debt, and that's larger than the defense budget. That's a big number. And in turn, the U.S. government is running deficits, which they ran during COVID. You could explain that, as a crisis, but they kept running them post-COVID. You would have thought the spending would go down. It didn't. And so, last year's deficit was 1.8 trillion. This one's running to something over 2. And here's what happens. To cover that deficit, they have to sell bonds. They sell bonds into a bond market of a fixed size. If you come to sell more, if there's more supply of bonds and the same number of buyers, then the price of the bond, the interest rate on the bond has to go up to entice people to buy them. That interest rate going up is what the federal government then has to pay on all the existing bonds as they roll over. That then makes the 1.2 trillion of interest expense become a bigger number in the following year. That then makes the deficit become a bigger number. That then means they got to sell more bonds. And you see where I'm going here? You've got kind of a negative feedback loop that really is at the core of the problem. And in fact, it was the U.S. 10-year moving from, when they first announced the tariffs, the stock market went down and the bond market did what it traditionally did. It was a safe haven and it rallied, and that looked good. That was kind of what dissent probably wanted. But that rally didn't last very long, and pretty soon people started selling the bonds too. And I think the reason for that is people realize that the stock market going down will decrease tax revenues, will increase social payments, and deficits will get ever larger. And so, this is a problem that, it's hard. It's Lynn Alden's meme. Nothing stops this train. It's very hard to reverse this cycle that we're in. And that's what's really leading to the sovereign debt crisis. And so, where it ends, we don't know. We can map out a lot of possibilities. The book does that. I give you a lot of scenarios, but it certainly doesn't end in less inflation. I'll say that with a high level of confidence. So he's really trapped. I mean, he really is. I mean, he should have resigned a long time ago. I wouldn't want his job.
For $180,000 a year, you got all the headache, right?
Yeah, right. Well, he's got $100 million plus net worth. So like I say, he doesn't need it. But as we know, ego drives people to do these things. But anyway, I don't know, honestly. I mean, they know they're running out of runway in terms of the ability of the monetary system to handle the debt. And I'll give you a couple of data points on that. First is they, at the last Fed meeting, they took the quantitative tightening, which is shrinking their balance sheet and reducing the money supply, or at least reducing reserves, which have the effect of reducing the money supply. They took that from 25 a month to 5. I thought that was interesting. They more recently have been talking about, some of the Fed governors were saying, well, we stand ready. When they saw the bond market back up from the low 3.38 to 4.4, so they very quickly went to Trump and said, sir, you got to put a 90-day wait on these tariffs. The bond market's falling apart, and so he did, and that got everybody calmed down. You also see other little inklings of money printing coming. There's something James Lavish did a really nice job in his Informationist newsletter of laying out how the hedge funds are one of the largest buyers of the treasuries, and they do that because they do a basis trade, which is to say they sell a future treasury and buy a current one, and they can make a spread between the two as time goes by. And they lever that trade up very, very highly to give themselves a large profit if and when it works. The problem is that those spreads disappear or become disorderly in a very chaotic market, and the hedge funds can effectively find themselves quickly bankrupt unless they have access to new money. And so a Brookings Institute paper came out and said, we think that the Fed should give these hedge funds preemptive swap lines, which means preemptively we're going to print money to save these hedge funds. Kind of what they did with in 2020 and the COVID crisis, and also in 2008 when they bailed the banks out. And so again, Kai, the book talks about this. I mean, the Fed really, at the end of the day, I mean, they have a lot of jawboning things they can do, but at the end of the day, the one big hammer they have is the money printer. And, if there's not enough money in the system, the debt keeps growing, they got to service the debt. Well, what do? You print more money to do it. And so that's what I see forthcoming, and that's why I named the book The Big Print. And I believe that big print is we're on the cusp of it. I don't know if it's in 2 days, 2 weeks, 2 months, but it's not 2 years. It's got to happen probably in the next 6 months.
Let's start with some raw numbers. The U.S. federal government is sitting on over $37 trillion in debt. And that's not a typo. It's more than 120% of GDP, and it's climbing fast. When Powell started raising rates to fight off the inflation they themselves unleashed with COVID-era money printing, something predictable and devastating happened. Interest expense exploded. We're now paying close to $1.2 trillion a year just to service the interest on the existing debt. That's more than the defense budget. It's more than the education budget. And guess what? That number's going higher. Why? Because we're still running massive deficits. Last year's was $1.88 trillion. This year's tracking even worse, possibly over $2.1 trillion. And those aren't wartime deficits. Those aren't crisis year deficits. That's the new normal. Every year we're borrowing over $2 trillion just to keep the lights on. And to cover that shortfall, the Treasury has to sell more bonds. Now here's where it gets dicey. Bond markets aren't bottomless. They rely on buyers. And when supply explodes and demand stays flat, or worse, starts shrinking, you get falling bond prices and rising yields. Which sounds technical, but it's not. It's a death spiral. Higher yields mean higher interest expense. That pushes the deficit higher. That means more bond issuance, which pushes yields higher again. Rinse and repeat. That's what I call a doom loop. And folks, we're in it. When Trump announced the latest round of tariffs, the market instinctively sold stocks and initially moved into bonds, like it always has. But that safe haven bid didn't last. The bond market started puking too, and that's when alarm bells went off. Because if the U.S. stock market is falling and the bond market is falling at the same time, where does the capital go? Foreigners are already selling. Think about it. If you're a Japanese or European investor and your U.S. equity investment is down 10%, and at the same time the dollar falls 10% against your home currency, you've just lost 20% in real terms. That's not a paper cut. That's a gash. And that's why foreign participation in U.S. financial assets is declining. The foreigners are pulling out. The Fed can't let that continue. But they also can't force foreign investors back in unless they offer real returns, which would mean even higher rates. And that would crush the government's ability to service its debt. So what do? They blink. At the last FOMC meeting, the Fed quietly tapered quantitative tightening, reducing the balance sheet unwind from $25 billion a month to just $5 billion. Nobody talked about it. But that move speaks volumes. It means they're laying the groundwork for the next phase, the return of QE. Not because they want to, because they have no choice. You can already see the signals. Fed governors are now openly saying, we stand ready. Ready to act. Ready to step in. What that really means is, we're watching the bond market and we're preparing to print. This is not hawkish policy. This is damage control. The bond market is starting to break, and the Fed is already massaging the narrative to make more easing palatable. Let me give you another example of how fragile this system is. The hedge fund basis trade. Most people don't realize that hedge funds have become some of the biggest buyers of treasuries. Not because they want long-term exposure, but because they run a basis trade. Here's how it works. They go long spot treasuries and short treasury futures. The spread between the two gives them a modest return if everything stays stable. But to juice that return, they lever the trade 20x, 30x, even more. That's fine in a normal market, but in a volatile one, that's a ticking time bomb. When those spreads widen or go negative, the hedge funds can't just ride it out. They face margin calls. That's what we saw in 2020. And it's what we're at risk of seeing again. This time, the Brookings Institute is already out with papers recommending preemptive swap lines from the Fed to hedge funds. That's code for, let's print money and bail out the leverage before it blows up. That's where we are. The central bank is preparing to print money to bail out bond buyers because the government can't afford to lose the bid under its own debt. And this brings us to the heart of the matter. The only real tool the Fed has left is the money printer. They can jawbone, they can adjust the dot plot, but when the market seizes up, when deficits balloon, interest expense spirals, and foreign buyers vanish, they will print. Not in 2 years, not in 5, probably within the next 6 months. The train is already in motion. The tracks are laid. The destination is inflation. And this is why I wrote The Big Print, because I want people to understand that what we're heading toward is not some speculative theory, it's a mathematical certainty. You can't service $37 trillion in debt at 5% interest without massive monetization. It's simply not possible. And every time they print to rescue something, whether it's the bond market, the stock market, or hedge funds, they undermine the purchasing power of the dollar. Inflation isn't going away, it's structurally embedded now. The Fed can't crush it without collapsing the debt market, and they know it, which is why they're backing off QT, warming up to QE, and laying the rhetorical foundation for the next printing cycle. They'll say it's temporary, they'll say it's targeted, but the effect will be the same. More money, less value, more distortions.
The model here is not that this price necessarily reverts to the mean. The model here is that the monetary system is changing. So a lot of people look at something, a price run like that, and they say, well, that's overbought. That's a bubble. That's going to break. I don't want to buy it. I'm too late. And we see this in gold and we see it in Bitcoin. I see it particularly in the Bitcoin world. I have a lot of friends I've tried to convince on Bitcoin. They might get convinced and then they say, gee, Larry, that's great, but I got to pay 85 or 100,000. You were buying it at 5,000. And, I don't want to do that. I'm paying top price. And what I would suggest is that you turn this upside down and look at it as a slightly different thing. It's more like, the old monetary system was stable and the new monetary system is an avalanche. And we've had enough snowflakes fall that the avalanche is broken free and it's got a ways to run. Or said another way, consider the old monetary system is the Titanic and it's being transitioned and changed to a sounder monetary system. And the lifeboat seats are represented by gold and silver and Bitcoin. And so, so I bought some gold at $1,000 an ounce and I bought some Bitcoin at $5,000 a coin, and those are seats in the lifeboat. The cost to you today, you want gold, it's $3,300. You want Bitcoin, it's $85,000. Same seat as the one I bought, but it's more expensive because we're a little further down the road. So, okay, Mr. Investor, do you want to continue and hang out on the Titanic or do you want to pay more for the seat? Because if I'm right about the monetary system and it failing, we know that, if you had been on the Titanic and the same kind of thing had happened, it wouldn't have mattered what you had to pay for the seat. You wanted the goddamn seat because the alternative was terrible. So, it's being a little bit extreme, but perhaps not too much. This monetary system really is quite broken, and you need to read the book because the book talks about the history of these kinds of things. And, it may not go all the way to the Titanic sinking. We may just have really high inflation and a monetary reset, to be fair and to say that, but even in that case, gold and silver and Bitcoin will be an advantage to have over, all the other traditional assets. The dollar is a funny thing because it's measured really in all the other fiat. All the currencies are fiat, right? There's nobody who's on a sound money standard right now. So you're measuring the euro fiat against the the British fiat against the Chinese fiat against the American fiat. So I think the American fiat, if you look at the income statement and the balance sheet of most of those countries, I think the U.S. is just demonstrably in worse shape than all the others, but it's been the reserve currency, so it's enjoyed a premium. I think the dollar has a long way to fall. All of those currencies, what they represent is they represent currencies, things you can buy things in. Everything's priced in dollars. You can easily do a dollar price of anything, as you can with a euro. And the FX markets are very efficient, so you can move from one currency to the other. So to me, how the dollar does against the other currencies, I think it'll fall because it's overvalued compared to the other currencies. But what really matters is not that cross. What matters is the cross between the dollar and gold or the dollar and Bitcoin. I think, look, Bitcoin does not have, and gold, there are mechanisms for doing it. I just heard about one actually in Britain that was pretty cool for kind of keeping, Bitcoin in your account or gold in your account and then paying for things in dollars or pounds.
We've already gone deep into the numbers. The U.S. government's debt is exploding. The bond market is no longer acting as a safe haven. And the only path forward is a wall of new money, what I've called the big print. But here's what I want you to really understand. This isn't some dramatic forecast of an apocalyptic collapse. This is a rational expectation of how a cornered system behaves. It's not fear-mongering, it's math, it's incentives, and it's already started. Let's zoom out and look at what happens after the big print begins. First, the Fed resumes asset purchases, not a soft restart of QE. I'm talking about aggressive, open-ended treasury purchases at a scale that absorbs $1 to $2 trillion annually, because that's how much the Treasury needs to finance its deficit without sending interest rates to the moon. But with every new dollar they create to buy bonds, they dilute the purchasing power of every existing dollar. Now, some will say that inflation will come down because goods prices are stabilizing. But that's the trick. Inflation doesn't have to come from oil or wheat or cars. It can come from services, housing, insurance, or simply from people losing faith in currency and demanding more dollars to compensate for that lack of trust. That's where we are now. We're seeing inflation driven by expectation, by the recognition that money is being debased on purpose. And remember, inflation is not just prices going up, it's the currency's value going down. In fact, inflation is just the symptom. The disease is money printing. That's why CPI is a lagging indicator. That's why you can have 4% CPI in a public that feels like everything is 20% more expensive. Because it is in the real world. As the big print continues, yields fall, not because the market is confident, but because the Fed is manipulating them lower. Real yields go deeply negative. And here's where the redistribution happens. Every saver, every pensioner, every wage earner, they're getting quietly taxed. Their dollars buy less. Their bank balances stagnate while real asset holders ride the inflation wave. This is theft, monetary theft through stealth. Eventually, capital gets the memo. Large allocators start rotating out of bonds and into anything that has a real supply curve. You'll see inflows into gold, into Bitcoin, into real estate, into commodities, and into businesses that own tangible, cash-flowing assets. The era of growth stocks riding on free money is over. The market's going to shift toward companies with hard assets, pricing power, and minimal reliance on rolling debt. Then comes the political panic. The public, feeling the sting of declining purchasing power, starts demanding answers. Politicians do what they always do: blame someone else. Maybe it's oil companies. Maybe it's price gouging. Maybe it's foreign governments. They'll push for price controls, subsidies, and emergency stimulus. But here's the kicker. Every one of these responses requires more printing. And that's how you know the spiral has gone terminal. Once the big print hits escape velocity, it starts to affect more than economics. It starts to affect national security. A weakened dollar means diminished ability to project geopolitical influence. It means higher import costs for key defense inputs. It means allies begin to de-dollarize out of self-preservation. And the U.S. finds itself having to choose between maintaining empire abroad or maintaining stability at home. You can't do both when the currency is burning. And as this reality sets in, you'll see the following 4 responses from governments around the world. Capital controls. When the money starts fleeing the system, policymakers will try to trap it. They'll propose transaction limits, wealth taxes, or even penalties for moving money offshore. We've seen it before. In the UK in the 1970s, in Argentina countless times, in Cyprus during the banking crisis. Inflation narratives. You'll hear the word transitory all over again, but this time it will morph into planned or necessary. They'll rebrand inflation as a social good, an equalizer. This is how they'll try to diffuse the growing anger about stolen purchasing power. Digital currency rollouts. Expect to see CBDCs, central bank digital currencies, rolled out under the guise of efficiency and financial inclusion. In reality, these are surveillance coins. They're about control, expiration dates on your savings, programmable restrictions, and ultimately, the ability to enforce negative rates or stimulus conditions directly on citizens. Gold and Bitcoin demonization. Hard assets will be framed as speculative, destabilizing, or even unpatriotic. We've already seen the IMF criticize Bitcoin. You'll start seeing think tanks publishing concerns about how gold undermines policy tools. Don't fall for it. That's the system defending itself. And amidst all of this, the individual investor is left with a choice. Act now or react later. If you've been listening to the mainstream narrative, you've been told that inflation is under control, the Fed is in command, and that U.S. debt levels can be managed with growth. That's a fantasy. Growth can't outrun compounding debt service at this scale. We've crossed the Rubicon. The real question is how individuals protect themselves before the system resets. And here's where we go back to basics. Own real assets, own productive land, own businesses that earn in multiple currencies, but above all, own sound money. Gold isn't a relic. It's not just a hedge. It's the most time-tested store of value humanity has ever known. And it doesn't need to pay yield because it doesn't default, doesn't dilute, and doesn't require trust in anyone. That's what makes it perfect for this moment. Bitcoin, meanwhile, is a modern parallel. It's code-based, transparent, borderless, and finite. In a world where surveillance and capital controls are expanding, Bitcoin gives you digital escape velocity. It's volatile, but volatility is the price of freedom. We are entering a world where those who hold promises will get wiped out, and those who hold assets will survive. That's not a slogan. It's how every sovereign debt crisis ends. Ask Argentina. Ask Weimar Germany. Ask Zimbabwe. The pattern is always the same. And so I'll leave you with this. You don't need to predict the future. You just need to prepare for the most likely outcome. The system is over-leveraged, over-promised, and under-reserved. It can't raise rates without imploding. It can't stop spending without social upheaval. And it can't tax enough to close the gap. So it will print. And it will keep printing until trust breaks. Don't wait until then to act. Because when they finally hit the red button, when the big print becomes official, you won't want to be the one holding paper. You'll want to be holding what lasts.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.